welcome back to the Higher for Longer channel. My name is Mason, and today I have a video that I'm pretty excited to make. This is a video that I've talked about in previous videos, or a subject I should say. Today I'm making a video covering the current situation going on with the US Treasury and its issuance. And the reason that I wanted to cover this topic is because I've seen many economists and market participants talking about the current issue coming out of the US Treasury. So today I really just went down a rabbit hole and tried to find as much good information as I could, and I really looked to provide my own thoughts and analysis of the information that I found, and I'm very excited to share it with everyone here. So let's go ahead and get a couple definitions out of the way before we really jump into this here. What is a Treasury bill? A Treasury bill, or T-bill, is a short-term U.S. government debt obligation backed by the Treasury. T-bills fund various public projects such as construction of schools and highways. When an investor purchases a T-bill, the U.S. government effectively writes an IOU to the investor. Therefore, T-bills are considered a safe, conservative investment since the United States government backs them. And that is directly from Investopedia. So now that we know what a Treasury bill is, we can talk about some of the market functions of them. And these are repo and reverse repo. First off, with repo, this is a repurchase agreement. It's a short-term secured loan. One party sells securities to another and agrees to repurchase those securities later at a higher price. A reverse repurchase agreement, or reverse repo. In a reverse repo, one party purchases securities and agrees to sell them back for a positive return at a later date, often as soon as the next day. Most repos take place overnight. Those definitions are from brookings.edu. Now I am going to explain the current situation going on in the Treasury market through the words of Raoul Pal. Raoul Pal is a former Goldman Sachs executive I've been following for a decent amount of time. His insights are pretty knowledgeable, and I definitely recommend you check him out. As Raoul explains the situation, rates have decoupled from the market and the business cycle. He says this is not coming from inflation, it is coming from market liquidity. So he is viewing this as supply and demand. This is because of the large issuance that is taking place to cover the interest that the government now has to pay on its short-term obligations. As we know, with the current inverted yield curve, we have the short end above 5%, with the target Fed funds rate around 5.5%. This issuance taking place in the bill market drains the reverse repurchase facility, but still flows into the rest of the market and makes yields rise, according to Raoul. The reason that is important is because if yields continue to rise, it is possible and has happened where the Fed and market officials lose control of rates. If that happens, obviously that is a danger to the market. It increases market volatility, and that is something that we need to watch, but I have more on that later in the show, so stay tuned. But now back into the discussion here. Raoul goes on to say, in December 2018, the repo market broke, and that is what caused cuts to come later. So we know this is a real point of failure that can lead to a stimulative response from government officials and agencies. This would be the big break in the economy that people have been predicting. Now, to explain what that means, I came across a video from the Brookings Institute, which I will leave in the description. It's very informational. A lot of the information is over my head, but again, the link is in the description. This video covers a very similar situation as to what's going on right now, where the Treasury market experienced a growth in the amount of treasuries due to large budget deficit increases in the United States. The Fed and foreign entities were not really buying treasuries at the time, very similar to what is going on now with quantitative tightening from the Federal Reserve, as well as foreign entities such as Russia not buying treasuries, China moving away from treasuries, as well as other governments who are trying to interact with the new developments coming out of the BRICS countries or other areas. And the market had a hard time taking in such a large supply. And this video then discusses Federal Reserve or practices and how they like to measure volatility in their markets, and that's something that is just well above my head, but I definitely recommend that if that's something that interests you, you check out the video. Again, the link is down below. Now, speaking about volatility, we can actually track that in the bond market by tracking the MOVE index. On screen right now, I have Bank of America's MOVE index. This index shows a rise and then a steep fall at the end of 2018 and into 2019, which is when the issue that was being discussed in the Brookings video was taking place. The middle portion of this 5-year chart is COVID, so obviously that's an anomaly. I won't read too much into that. But the MOVE index has seen a large increase since the beginning of 2022. As you can see, starting in even July of 2021, and then into 2022, and now into 2023, there's been a huge run upwards. And what that means is volatility in the bond market is beginning to increase. Now, does that mean that things will immediately turn bad? We don't know. There could be more volatility to come in the future and even higher spikes, but the trend is increasing. And what that means is there is volatility in the bond market. And as volatility gets too large or too crazy in these large markets, they can get out of control. And that is what causes intervention in the market by either governments or government agencies. So as we see this increase, if it continues, we know we need to continue to watch and wait and see if some sort of response comes from policymakers. And now up on screen, I have the 2 and 10-year inversion chart from Fred. This is our central bank's data website. Anyone can go and track anything on there that they like. I'll leave a link to Fred in the description as well. This is, I believe it's the St. Louis Federal Reserve Bank. So the reason that I wanted to show this chart is to show that we are currently pretty strongly inverted, and inverted for the first time in quite some time. So that's worth noting, because the increase in volatility that we have likely seen is that this yield curve inversion is trying to correct itself and get back to a positive slope. And what I mean by positive slope is obviously no longer inverted. So the 10-year would yield more than the 2-year, which is currently not the case. And while that is an indicator of recession and something that is generally noted by economists or market participants, my point of showing this at this current time is again to show that the volatility that we are seeing is likely the curve trying to re-steepen itself through the bear steepener, which I talked about a few videos ago. So go check those out and take a look at what I mean when I say bear steepener. But as that continues, volatility will, in my opinion, likely continue to increase, and that volatility could lead to intervention by government agencies or officials. So keep an eye on the yield curve as well as the MOVE index to track the bond market and what is going on over there. So now to what you listen to this show for, and that is what I think this means for us as market participants. So this is my opinion, but governments don't seem to really care about things like risk markets such as equities, and they're even letting larger markets like real estate and commercial real estate head down paths that are less than rosy, to say the least. What governments really tend to care about are their own personal funding, and they fund themselves through their bonds and through their treasuries, which is where they sell their debt. These are the markets that, when these places experience tension, that is when the government or their authorities tend to take note and tend to act. That is because these are direct funding for the government. These are the markets that truly have an impact at the highest level. Even things like real estate, while those markets may have negative impacts on banks like we've seen, or personal people or companies, those are not the markets that the government tends to take note of. And even if they do take note of them, those markets very rarely, if ever, affect their own personal funding. At least that's my opinion. So when these markets begin to show problems, and by these markets I mean treasuries and bonds, they have to fix those, or else the government then runs into problems funding itself. And these fixes may likely lead to some sort of stimulus. The stimulus may come in a form that's more covert, like the Bank Term Funding Program, which we experienced when banks were collapsing, where a new program was set up and it ultimately ended up on the balance sheet of the Fed. Or they could also move in a more direct and outright action, like rate cuts from the Federal Reserve, or direct government stimulus, or market intervention. When this happens, I believe that this will lead to heavy volatility in risk assets, and that volatility could likely be to the downside, in my opinion. If the actions of these authorities are not taken well by the market, in other words, catch the market off sides, as in they are not prepared for what the national entities are telling them they need to worry about, that would likely cause volatility to the downside. But I believe that that would be a short-term reaction, because it is important to remember that currency debasement that comes from stimulus raises asset prices in the longer term. As the denominator of those assets, the fiat currency, is devalued, assets rise in nominal price. So as long as you play the long game, you can take advantage of these market sell-offs, especially when the market sells off due to market conditions. Those are the times, in my opinion, that you take advantage of the volatility to the downside. All right, with all that said, thank you so much for following along. I really appreciate everyone that listens to the end. Let me know what you thought of what I had to say. If you think I'm a complete idiot or you think I'm completely wrong, I would love to hear why in the comments, and I would love to have a discussion covering these markets. I will continue to follow the bond market and the treasury market as we progress through the year. I think it's going to be a very interesting place to watch what kind of volatility takes place and what kind of moves in the market occur, and what the government's reactions or market participants' reactions are to those events. So a lot of exciting data to come. Thank you again for watching. Please like, subscribe, share. Any person that leaves a comment, I really appreciate it. And thank you. Have a good day.